Thank you, everybody, for joining us. My name is Devon Drew, founder and CEO of AssetLink. Today, we are pleased to be joined by Tim Kramer of CNIC Funds as we discuss the electrification of America and how to invest in that. AssetLink is a data-driven community that connects the preferences and characteristics of fund managers, financial advisors, and accredited investors and matches you all based off of that. Now, one of the investment solutions and the fund managers that we work with at AssetLink is Tim Kramer with CNIC Funds. Now, Tim, I thank you first and foremost for joining us. We're really excited to have you because something that's top of mind for everyone is the demand for energy continues to rise. How in the world can it be sustainable and is it investable? And I think that you have a solution and could speak to the investment opportunity that's in front of us here.
Yeah, appreciate it, Dewan. Thanks for having me on today. So when you talk about electricity use in the US for the past couple decades, typically the growth in demand has been like 0.5% a year, so nothing spectacular. Right now, the regions that do these predictions, they're saying, okay, we're not looking at 0.5% in the future. We're looking at something like 1 to 3% in the future now. And we still think that that number is understated. We think it's going to be a lot bigger than that. So our basic thesis in the electrification of America is that we think that supply is greatly overstated and that demand is greatly understated. So to kind of address that on the demand side, you've got manufacturing facilities. And right now, federal legislation is saying that they're encouraging what they call a domestic content for this development. So just basically keeping everything, all the growth in the US. So that's going to give you bigger loads, bigger demand. And then for like the industrial and the residential demand, I mean, everything has become an electric these days. So if you take a look, you can't pick up the paper without, a headline somewhere about electric vehicles. And so what's going on right now is the states and the manufacturers are saying sometime between 2030 and 2035, all new cars have to be electric. Whether or not they can achieve that, not sure, but that's definitely what their target is. Another thing is we call this the no gas stoves rule. And that is there's several states and cities that have enacted legislation that says you cannot hook up new residential buildings to the natural gas infrastructure. You got to hook them up to electricity. And you've even got certain places that have banned gas-fired electric lawn equipment. It's got to be electric now. So just seeing a real big pickup in demand from all sorts of different sources that nobody really has seen before. And then with respect to the supply, the US has a stated goal of being 85% renewable generation by 2030 and 100% carbon-free by 2035. And the problems that you're having is that's getting difficult to meet. So like right now, kind of the case study for this would be a company called Ørsted, and they do offshore wind. And they've had to either rip up or cancel a lot of their contracts because their costs from 2021 till now have gone up 50%. And if you think about it, higher interest rates, higher material costs, et cetera. So it's more expensive. And so the supply we think is overstated right now. And we think the demand is understated. And then there's one more interesting element to add to that. And that's kind of the infrastructure. So even if you can build the wind and the solar that people are talking about, when you build these require a lot of land and people don't want those things built right next to them. So they're built where there's not a lot of population. The transmission and the things that are needed to get that renewable electricity to where the demand is, that's just not in place either. So we think there's a really interesting supply-demand dynamic that's going on right now, and we think there's a way that you can capitalize on that.
Oh, thank you for that. That's sounds like there's an unprecedented opportunity in front of us. Like what made you come up with the first ever electricity futures ETF, right? Was it the premise that you saw in your past life working at Blackstone and Duke, or like what prompted you to see this as an investment opportunity and to bring it to market?
So electricity is the most consumed commodity in the US on a retail notional basis, but it's not in any index, any mutual fund. It's not in any ETF, nothing. And it's like, wow, that just doesn't make any sense. And so we took a look at the amount of money that is currently tied to the existing broad-based commodity indexes like the Bloomberg Commodity Index or the Goldman Sachs Commodity Index. And there's like 800 trillion or more tied to those broad-based commodity indexes. That's like, wow, why? It's outdated and it needs to be refreshed. So we started out by building the electricity index, a partner with ICE, Intercontinental Exchange, owns the New York Stock Exchange. And then we launched the ETF, and then we think that there's things that we can kind of bolt on to this. So it was nothing more detailed than it just looked like it just doesn't make any sense why someone's not serving like the biggest commodity that's being used.
No, that makes sense. And then when you start talking from an industrial versus residential, like the electrification of transportation and buildings seems like it could be another potential opportunity. Are you taking advantage of that when it comes to EVs? I know you mentioned some potential bans, but how does like the EVs or the gas hookups in, let's say, like Illinois, New York, or California come into play?
Sure. So the index and then our ETF, those are based upon a national average of what power prices are for the U.S. So we take six of the major U.S. traded hubs, and we use exchange traded electricity futures, and we put those together in a certain weight that kind of mirrors what the different percentages are for those parts of the country. And so our product gives you an overall exposure to what electricity prices are doing in the U.S. So as the different areas start to become more electric and get cleaner and or use more electricity, bigger demand, our index reflects that and our ETF reflects that.
Gotcha. Thank you. So you mentioned like there's no way to access the electricity markets, and you are first market. Why do you think that is, right? I mean, I'm sure like maybe in the private markets or the private equity side or the private debt side, there's some opportunity, but what makes this unique and like why are you the person to bring this to market?
So I would say, first of all, for the private equity, the private debt side, you can access like the companies themselves that produce the electricity,
Right.
but you're not accessing the actual underlying commodity futures. And so that's why we kind of think we're unique on this. The reason, people haven't done this before is the very first commodity index was developed like in 1974. And that didn't become a commercial product until like 1998. And so it takes time for people to get educated about these things to kind of understand what's going on. And so once that first commodity index in 98 got launched, then it's like we talked about, 800 billion or more today. And so electricity really wasn't deregulated and really didn't become a tradable commodity with futures until, we'll say the early 2000s. And so as people start to become more and more aware of that, and then the whole, the premise of making the US, green and carbon free and the whole ESG movement, that's just kind of made people more aware of electricity right now. So we think we've got good tailwinds and that it's in the headlines every day and that we're the only way to play it.
Yeah, that makes sense. Can you talk a little bit about supply, right? Now, the cost to produce versus the cost to produce um, from supply and renewables perspective. I'd be curious of your thoughts there and how, interest rates moving higher potentially or lower, materials being higher, or the offshore winds plus price increases would have an effect on electricity supply.
Oh, sure. Good question. Because we always have people that say, well, wait a minute. If we're going to have all wind and solar, I mean, those things are free. Why isn't the cost of electricity going to be zero in the future? And the first answer is it costs money to build those things. And the guys that build them, they want to make a return on their capital. So that's why those things are expensive. And that's why the electricity that they produce has to have a certain price associated with it so that they can kind of recoup their investment. So that would be the first piece of this. And then the second piece is as you add these renewables, you come into what's called basically dispatchable versus non-dispatchable. So right now, you've got almost 60% of the US generation is natural gas and or coal. And so they're fossil fuels, but you can vary the output of those generators. So, if you're in a hot summer and you need a lot of electricity, and then all of a sudden a cloud comes out and you don't need as much, you can change that output. But with wind and solar, you can't vary that output. If the wind's blowing, you get it. If it's not blowing, you don't. Same with the sun. So you still need to keep around some element of these dispatchable generators, and they need to recover their costs also. So what happens is you just don't have enough batteries to store what the wind and the solar create. And so you still need to keep around a certain amount of fossil fuel, and those guys need to make their returns also. So it's all about just getting return on your capital. And as you put these renewables in there, you're actually just kind of making this more volatile.
Gotcha. No, that makes a lot of sense. And what we want to do is we want to be able to encourage the audience to ask questions, right? So as we go, feel free, whether it's in the chat feature or the Q&A box, feel free to ask any questions, and we'll ask them as soon as they come in. One thing that's top of mind, that, the question that came in via email, is speaking about climate and the effect on electricity. And
Oh yeah.
I'm sure you hear that all the time. Can you speak
Oh
kind of
yeah.
high level, and then we could, then we could get a little more granular with it?
Yeah, sure. So first of all, I would just say this. If you say global warming, you're going to get some visceral reactions from people about whether or not global warming is real. So we tend to try to say climate change because that's what the Paris Accord and that's what everybody else tends to like to go with. It's less controversial. And there's no doubt that what we're doing is changing our climate. So what happens is with climate change, you get just let's just say you get more extremes. And so what you've got is like you've got a higher incidence of like tornadoes and hurricanes. And then in terms of like cold snaps and or heat spells, you'll still have those things and they'll be more intense, but they'll be like shorter duration. And so if you take a look at like what weather normalized power demand is. So in essence, if you just kind of say what's demand been, and I want to take out the effects of just the temps and see what that looks like. So for a place like Texas, if you've got, basically normal temperatures, mild temperatures, or even the extreme temperatures, Texas load has been growing and demand has been growing about 2.5% per year over the past 5 years. And that makes sense because you see a lot of industries that are moving into the state. Now, kind of the other side of the coin is if you take a look at a place like California, if you've had over the past same time period looking at what demand is and correcting it for weather, if you've got mild weather in California, you really have flat demand. It really hasn't moved that much over the past 5 to 7 years. But if you have the extreme temperatures, which you're getting more of because of the climate change, if you've got extreme cold in California, you're seeing like the annual year over year growth being like 5% in demand. And on the heat piece, it's like about 3%. And so that also makes sense because if you think about that, California's got one of the highest percentages of renewable generation fleet in the US. And again, those things aren't dispatchable. You can't change the output. So those extremes just tend to make things more volatile. So the climate change and kind of the increased volatility, and combined with the fact that a lot of these generators aren't dispatchable, just gives you a really interesting price dynamic and what's going on with the US fleet.
Yeah, that makes sense. So I think that leads me to talking about extreme weather. I know it's been, I know it's been top of mind. You can't turn on any news outlet without talking about how extreme, how storms are going to continue to get more extreme. And I would just have to assume that if they are accurate, then the price of electricity should go up, or the demand should spike, right? Which kind of represents, and if I'm thinking about like an investment opportunity, if we're understating it, and storms do get more extreme, and the demand for electricity, it should be able to opportunity to make money. But can you speak a little bit about your thoughts on extreme weather? I think recently we had like an El Nino or a double El Nino, and how that makes your job interesting.
Sure. So you had an El Nino last winter. So last January and February, you had what was, I think, like the warmest January and February in the U.S. in the past 50 years. Right now, you have the warmest February in the U.S. ever. So the odds of having a back-to-back El Nino are like less than 10%, but we're going through that right now because, again, you're back in the extremes. But even though you're talking about this, you still had some really cold snaps and a lot of snow in the Midwest that actually made its way over to the East Coast. And so you're seeing, like we talked about, the extreme weather, you're seeing those really short bursts of intense cold. And then the predictions are for this summer, again, they're already saying that this coming summer, you should see some really, really big heat waves coming through, shorter duration, but a lot more intense. And so what happens is that volatility, when you apply that to kind of power prices, power prices aren't really going to go to zero but you have the ability to go to several $1,000s. And so with an asymmetric risk reward profile on where the power prices are, we just think it's a good opportunity to kind of be in it to participate in that.
Yeah, that makes sense, and thank you for that. Once again, if there's any questions, feel free to ask it in the Q&A box. You know, you mentioned about Texas. So are you from Texas? And then how does that, I know Texas was under some scrutiny a few years back with the freeze, right? And how that has helped shaped the kind of landscape when we're 2.5% per year across all temperature ranges in like Texas right now. Sure, that has, tremendous strain on Texas's grid.
Oh, sure. So Texas, for the very reasons that you talked about and what happened in some of the recent storms, they're concerned about what their supply looks like. And so originally people are still trying to, again, reach these goals of, 100% renewable generation by 2035. But Texas has now come out and said, look, we're not really sure that we're going to be able to achieve that. And even if we do, we're not sure how stable the grid is going to be. So they are now actively looking to add gas-fired generation back onto the grid. So what happens there is they're recognizing the instability, they're recognizing what can happen with prices, and they're trying to figure out how they can get in front of that, along with kind of recognizing what the demand is. And so there's some other interesting demand stats, and like one of them would be AI, because I just think these sound bites are just really interesting. And so that is, if you do a Google search, that takes like 1 watt of electricity. If you do an AI search, exact same search, but you do it on AI, it takes 100 watts of electricity, but it takes 1,000 watts to train that. So right there, AI in and of itself, kind of just making this the demand much stronger than people realized. And then when you talk about AI, you usually wind up talking about data centers. So in 2023, about 2.5% of the electricity demand in the US was for data centers. And the prediction is that's going to grow as high as 10% by 2030. And then my favorite one here is crypto mining. You can't talk about AI and data centers without talking about crypto. And so my favorite soundbite is Bitcoin mining in the US consumes as much electricity as the state of Utah. So people always kind of, what? Yeah. And 40% of all crypto mining in the world occurs in the US. And so back to Texas, Texas is the largest crypto mining center in the US. And it's supposed to see somewhere between 7 to 10% of its load in the next 10 years is supposed to be for crypto mining. So again, back to the Texas specific, but kind of what you're seeing in terms of technology and AI, just increasing the demand and making this a really interesting space to be in.
Yeah, I was reading one large language model search is the equivalent of a light bulb being on for 24 hours. So I don't know how true that is, but it all screams to me, it all kind of screams to your point, and one of the reasons why you created Amped, the ETF, is that we are grossly understating the demand for electricity.
Oh, yeah.
And if we're even close to being right, there's going to be an extreme investment opportunity. So would love to ask your questions about the ETF Amped. Can you talk a little about it, the strategy, kind of what your thoughts are, and like why potentially right now is the time to look into it?
Sure. So anytime you buy something for your portfolio, you usually buy it for one of two reasons, right? You buy it for strategic or you buy it for tactical. Strategic is, why am I going to buy it and hold it and put it away forever? And tactical is like, why should I own it now? Why is it going to go up? How can I trade in and out of this thing? So for the strategic, why should I buy and hold this and put this away? We typically want to point to three reasons. The first is the model portfolio. So for the longest period of time, people said 60-40 for your portfolio, 60% equities, 40% debt. In the past, we'll say 5 to 7 years, that's kind of getting kicked around a little bit. So if you take a look at 60-40 versus 60-35-5, with 60% being equities, 35% being debt, and 5% being a broad-based commodity product, that's beaten the 60-40 over that time period on a risk-adjusted and an absolute basis. If you take a look at 60-35-3-2, with 3 being the broad-based commodity index and 2 being Amped, that beats everything. So we think, number one, model portfolio. Number two, inflation protection. Amp provides inflation protection for you. So every month CPI comes out, and electricity is 2.5% of CPI. So it's in the numbers. It's actually indirectly in a heck of a lot more things, but it's directly 2.5% of the CPI. So it gives you the inflation protection. And then the third reason for strategic would be portfolio diversification. The fundamentals that affect stocks and bonds don't affect electricity. So there's really no correlation on amped versus some of these other standard products. From a tactical standpoint, like why should I buy this now? Or why do I think this is going to go up? The first thing is like we talked about with the fundamentals. I mean, this is just getting wound up tighter and tighter and tighter. So under normal weather conditions, people would say, "Oh yeah, we're good. We have enough electricity." Now they're saying, under normal weather conditions, we think we're good. We think we have enough, but the load growth is kind of catching us by surprise here. And they're already coming out and saying, under extremes, we got problems. So we think that's still conservative. We think that you've got, under normal conditions, you've got issues, and under extremes, you got big issues. So we think the fundamentals are there, number one. Number two, which we touched on, we think that this amped right now is a very cheap call option on electricity and electrification of America, simply because power prices aren't going to go to zero, but they can go a heck of a lot higher. So there's not much downside to this, and we see a lot of upside. And then the third reason is you actually get paid to hold the position. And so to kind of explain that a little bit is when you buy any kind of a product that's got futures in it, you'll have to post up, we'll say 15% of that in cash as margin to support the position. The other 85% still supports the position, but that earns the risk-free rate, usually in SOFR or T-bills or something like that. And so if you bought amped and prices never moved for 1 year, your return on that would be the risk-free rate. So, the fundamentals, the cheap call option, and the fact you get paid to hold it, we think from a tactical perspective also makes this a very interesting play.
That's pretty interesting. Now, amped is an ETF, right? So you start hearing about, electricity futures. Like, why an ETF? Like, did you explore any other vehicles, and why did you ultimately settle on an ETF? And then who did you partner with to do it?
Sure. So with respect to this being an ETF, the reason we chose that is because the electricity futures trade like almost all day long, constantly moving. And so in order to reflect that, the ETF trades all day long too. If this was a mutual fund, then you're willing to get the end of day pricing on that. So we wanted to kind of match the transparency that you get with the electricity futures and give you the same opportunity, but do it via the ETF. And the second reason is just availability. It's just easier for individual investors as well as institutions to participate in the ETFs. And so, we created this. We partner with ICE. We have a 5-year exclusive on the data and the index. So we're the only guys that can do this. So if you want to participate in what the futures are doing, we're it.
Yeah, that makes sense. I'm curious, you're seeing a lot of ETFs out there. It seems like, you know, every day, right, there's new ETF. And congratulations. I read that your Amped ETF was nominated for ETF of the year. So congratulations for that. I was looking at that list prior to the call, and I noticed there's like it feels like it's all flavors, it's all like the same flavors, right? And I think it's, I think being able to, if I'm an advisor, being able to offer an investment opportunity that is differentiated and correlated, I think it makes for a heck of a story. And you start seeing these ETFs pop up. They're essentially, the same thing with a different ticker. So congratulations for identifying this opportunity and that now that you are in such rarefied air, so to speak. Can you talk? I know, I was reading one of the articles. It was talking about, um, you know, an exclusivity period. How does that make you different? And then what is the potential opportunity for investing for the advisors and their clients to Ampton to right now?
So with respect to the exclusivity, like ICE is the premier futures exchange for electricity futures. And they've been around since I believe 99 or 2000. And it's pretty much all the volume, all the professionals, all the hedgers, all the utilities, pretty much everybody uses ICE to do their transactions. And so we feel very fortunate that we were able to partner with them. And so we designed the index, partner with them. And that's how we have the exclusivity where we're the only guys that have access, to this index. And so we're the only guys that can do this product that is benchmarked to that index.
No, I mean, and then can you speak a little about the investment opportunity? So let's say, what we're seeing now, right, is more and more RAAs and advisors being able to access, access ETFs and access things in different ways, right? One of the ways that I've seen recently, and I just came from a conference in Miami called iConnections, which is a global alts connection, is more and more RIAs are actually taking GP stakes and having different economic tie-ins to some of these ETFs that are coming to market. Do you have any of those relationships that have helped back Amped, or is that an opportunity for anyone in the audience?
So we've been approached by several RIAs, and I think the phrase that they've used with us is that the RIA business right now is a knife fight to the bottom on fees. I'm not in the business; I'll take their word for it. And so some of them have approached us about saying, "Listen, if I am one of the first significant sources of AUM for this, what does that look like for us?" And so we've had conversations with, depending upon what the size of the initial AUM is versus would we entertain somebody having a stake in the GP? And the answer is sure, we're happy to have those conversations. So that is something that, given the right partnership, if we think it makes sense for both parties involved, we would absolutely entertain that.
Yeah, but I'm also sure that there's probably some other larger private equity institutions and other larger broker dealers that are probably chomping at the bit to get this first mover advantage as well.
We have ongoing conversations because we have the ability to brand or co-brand this with anybody that we want to. So, I can put any one of the big wirehouses or a mutual funds name or anybody's name that we want to on these products. And so they can be the only ones that can offer these things for an extended period of time. So yes, we're having the conversations with the larger platforms, and they tend to like the fact that we have the ability to license or sub-license the index that we created with ICE, as well as the fact that they can be the only ones to put their names on these products, and they can choose to offer them standalone or in a model portfolio. Absolutely.
Man, that's good to hear. So what's next? I know that, I know you're probably, excited, right? Because, Amped is one of a potential franchise, I assume, right? So what's now and what's next for CNIC funds?
So we've actually just tried to pay attention to what some of the inbound pings have been. So really good initial receptivity for AMP in terms of what the questions investors are asking us and what they think the future is. But then when we respond, they'll say, "Well, this is great, and how about can you do A, B, and C also?" So we have two more products that are basically done and ready to launch. And the first one of those would be like we talked about here. It's taking a broad commodity index and it's adding electricity into that so that the most consumed commodity is now involved in a broad commodity index, like we discussed. And so we've partnered with ICE on that, and a couple other commodity indexes have reached out to us and asked if they could participate too. So we've got several different versions of that, and that's the reason we haven't launched yet. Is we're trying to figure out which one of those has the biggest appetite. Another product that we have is people have approached us and we developed this and it's pretty much done. Is Henry Hub natural gas futures have been for the longest time like the default go-to reference for natural gas prices in the US. And that's now being seen by most of the industry players as being a little bit old, outdated, and tired. So we've created a product that addresses that. That one's pretty much done and ready to go, and we're getting ready to launch that. So that's three products right there. And then we're about 80% of the way done on a product that treats water as a commodity in terms of cents per gallon. And that's got, people saying, "Oh, wow, every time I pick up the paper, if I'm not reading about electricity, I'm reading about the US running out of water." So they're very interested in that. And then we still continue to get inbound pings about, different ways that we can combine these things. So where we started out to basically be a one-trick pony with Amped, we very quickly have three more products that are done and ready to go, and then a bullpen of probably 7 to 10 more that we think there'd be a good appetite for. And again, all these are going to have some form of exclusivity, so we have some form of a competitive advantage in the marketplace.
No, this is exciting. I can't wait to turn on CNBC and seeing you and team ringing the bell with, a bunch of, advisors and private equity folks and investors behind you, because we really feel like this is a differentiated investment solution that could offer clients a non-correlated way to get access to the electrification of America. So we are at 12:31 right now. This is pegged for 45 minutes. Just want to open it up to the audience, right? And we have a few other questions that we can ask, but want to open up to the audience, see if you have any questions, any thoughts about, CNIC, about Tim, his background, about the investment opportunity, about Amped. So does anyone have any questions out there? Quiet crowd, Tim. That just must mean you've given them a lot to think about.
Or it's Thursday lunchtime on Super Bowl weekend.
Is it lunchtime? Oh, well, it's yeah, 1:30 here on the
Yeah.
East Coast, probably 12:30
Yeah.
on your time. That could also be the case. So any anecdotal factoids that we need to know, right? So for instance, if an advisor in the audience wants to find out more information about Amped or about CNIC, where can they go? And then what is a 30-second elevator pitch or even a 15-second elevator pitch on why they need to be allocating to Amped?
Sure. So if you want more information, the website cnicfunds.com. And we try to put up like a white paper, and we try to make them short, like 5 to 7 pages, that answer different questions that we seem to be getting over and over again. So there's a whole slew of white papers there that I think are a good resource, including like how we built the index, why we built it, and how it reacts, how it fits in the model portfolio. And that's where you can go to. And if anybody has any direct questions, I'm happy to. You could just via the website, you can reach out to me directly, and we're happy to answer any questions that we can come up with in terms of bespoke answers. In terms of like the 15 to 30-second elevator pitch, I mean, everything in the U.S. is going electric, and the only way that you can participate in that directly is with AMP right now.
And then what about for folks that are looking into some of your other products?
The other products, we should be launching the broad-based commodity index with electricity in it sometime, probably April timeframe, and then the natural gas one probably May to June timeframe, and then the water is targeted for like the end of Q3. So hopefully, we'll have those things, properly marketed and properly distributed, so that they'll get some good press releases, in concert with ICE, and those things should, I'm hoping, get some good press.
No, that's great to hear. And just so folks know, right, if you're folks that are already in the AssetLink community, if you are looking to access and connect further also with Tim, you can go to assetlink.ai on app.assetlink.ai, Timothy Kramer, and you're able to see what Tim did on the Animal Spirits podcast, which had over 22,000 downloads. You're able to see his investment profile, information about Tim, his business expertise, any of Tim's business diligence documents. You're able to see information on his strategies as well and his ideal investor. And if you don't have Tim's direct contact information, you can get that here as well. So once again, assetlink.ai is a great way that you could access Tim, and then you could also see how you and your practice matches up with Tim and if it's a fit into your overall portfolio. So once again, I'll give the opportunity to ask any questions to Tim about Tim, background, prior experience. This is your time. We have till 12:45 or 1:45 East Coast time. So I'll give you a few seconds to ask away. All right, no additional questions. Tim, any parting words?
I just appreciate the opportunity. It's always good to see you, Devon, and you always bring a good audience and ask thoughtful questions. And so thanks for having me.
All right, so everybody, once again, my name is Devon Drew, founder and CEO of AssetLink. There will be a brief survey at the end of this. It helps us get better offering these webinars and helps Tim with any type of feedback. So if you don't mind in answering that, and we look forward to following up with you soon. All right, thank you, everybody.